All right, you guys ready to talk state tax? You thought you had enough with tax reform last year. I know we just all probably have figured out what that means. Maybe you haven't filed your returns, but we're about ready to experience the same thing here in the state of Oregon. So beware. Hopefully, Dan and I will make you aware of some really important things that need to be on your radar. I'm going to hit the legislative session, which just began, and it's so early, so everything I say will change. But I want you to. I'm going to touch on a few things that are important that you should be thinking about how it affects your business. Dan's going to hit some prior year legislative things that were implemented that I don't think people realize how it will affect them. A super important U.S. Supreme Court case. First time we've heard a U.S. Supreme Court case since '92. It affects anyone that's selling a product that's taxable. And if we have time, hit on some enterprise-owned stuff. And I know So Ready is very involved in that here in the region. So, all right, 2019 session. Just by coincidence, Kate Brown was down here yesterday, and Dan and I ran into her in the airport, and we didn't get a chance to talk some of these proposals, but we've been in part of a lot of the discussions. There's 4 primary areas that I want to hit on. All of them have a revenue impact. There's a lot of other stuff that's going on in this session. It's a long session. It runs through June, but the things where potential money be coming out of your pocket is what gets me interested, because that's what I want to talk to our clients about. The first one, we don't have a lot of the details on it. It's the cap and trade. It's been talked about a long time. But the method in which they'll fund it, the funds that are used, from this cap and trade or cap and invest, I've heard it called that as well, will likely be in the form of fines or a tax, for large emitters. We don't know what that looks like, but we know it's really important. So something to look out for there. Education, that's the big one. That's the one I'll go into a lot more detail on. There's a price tag of $2 billion attached to this, and that's a big number, and it's all going to be borne by business. So it's going to affect this business community and other regions within the state. So that's the big reform that we'll get. Some other things, we just had a big Medicaid expansion. Preparing for this, I didn't realize we have over 1 million people in Oregon that are on Medicaid, so over 25% of the population. That surprised me. So to pay for that, we just implemented a 1.5% gross receipts tax this last session on healthcare plans. Now, as a result of the expansion, now that likely gets raised to 2%. So your cost of health insurance goes up. And they always like to throw in the increased cigarette tax. I like that. Washington did it. We should do it. And then another one, which is interesting. It's a program that's reimbursed by the federal government. So the tax, the hospital tax going from 5.3 to 6%, really ultimately isn't borne by the hospitals, as there's a reimbursement from the federal government. So one of the other priorities, paid family medical leave. That's kind of a very hot trend. At the state level, you have federal law, the FMLA, that provides for, you to be able to have your job if you need to leave a job for a birth of a child or for health reasons. What's unique about that, the federal law, is it doesn't require any sort of compensation when you're on that leave. All these states have now, California's got a program. Washington is considering or partially adopted it. This is a high priority to provide some sort of benefit to people that are on leave, that would be separate and apart from employers that already have those kind of plans in place. The question, how is it paid for? Last year we had the transportation bill. We got our first payroll tax in the state. So now the proposal that I'm hearing in the meetings that I'm in is that it's going to be paid for through expanding that statewide payroll tax, which is interesting. Some of the proposals include both on the employer and the employee. So that'll be interesting to see how that develops and the amount of money, that needs to run this fund, because it's going to be potentially a state-administered fund that pays out all these benefits, similar to California, sort of. So let's go to the education plan. It's $2 billion, so that's a lot of money. So the devil's in the details. What does it mean? I guess you kind of have to step back. A lot of the economists that I work with, the LRO and other independent economists, when they do studies on Oregon, what they all say, they all agree on, which is hard to imagine all economists agreeing on something, is that business isn't paying its fair share of taxes as it relates when compared to other states. So Oregon's kind of an outlier. But we rely heavily on our personal income tax. We all know that. We have a super high individual income tax rate. We have no sales tax. So business, surprisingly, in a lot of states pays a lot of sales tax. But because we don't have that, our tax system isn't as efficient when we have, rises and falls in the economy. And so the thought is, if we're going to have this big investment from an education standpoint, business has to pay for it to equalize, who shares, fairly in the tax burden. So the legislature and all the key committees are really focusing on business, how to make that, more fair. And I'm not saying it's the right policy. I'm just telling you what I know today. So, from what I'm hearing, and you probably read in the paper, where these investments are going are to this classroom, school year, graduation rates, mental health, attendance. Hearing some of the statistics that you've probably read about, I won't go into the detail on, are pretty alarming. It's pretty surprising how low Oregon actually is. And so, likely we do need some investment. So, how are they going to pay for it? There's a lot of different proposals. I'll go into some of the details on what those look like. But some of those proposals could phase out the corporate income tax. I would really like that. Every time you add a new tax to me, I think you should get rid of one. I don't know that we get there, but we probably get some sort of buy down of the corporate income tax, some sort of buy down of the personal income tax, to make Oregon a more attractive place while raising new revenue along the way. Whether that actually happens, I don't know. We have a supermajority, and there's going to be there's a lot of power to do exactly what the legislature wants to do. So how that ultimately plays out is kind of uncertain. What I can say for certain is we're likely to see some sort of business tax, and the form of that is what's really interesting. And it's likely going to be a gross receipts tax or a modified gross receipts tax. Some people are calling it a value-added tax, or a business activities tax, which a lot of people are starting to use as well. The thing that will be unique about it is a lot of people, when you think tax big companies, you're thinking, oh, that's just the publicly traded C Corps, multinationals. No, this is going to be on all business, with some exceptions, small business, and that's something that's being defined as we speak. I currently sit as the co-chair of the Tax and Fiscal Policy Committee for the Oregon Business and Industry, and through that membership, what I hear a lot is really concern by the business community. There's acknowledgement that there's an investment need, but there's a skepticism that the money that's raised doesn't go where it's actually needed, and it's really all going to address PERS. So I think that's an interesting thing. I hope some PERS reform is done so that the business community kind of leans in on this and is more supportive in the process. All right, so who are the players? I mentioned OBI. They have 1,600 business members in the state. There's all sorts of different coalitions that are forming. The Coalition for Common Good is a new organization. I was just on my first call with them yesterday. It's my understanding they have direct access to the governor's office, the Public Employees Union, a lot of the educators. I saw a large healthcare organization that was part of this coalition. Nike was the lead sponsor, and I know they're actively looking for others as well. My hope is everyone just works together and finds something that makes sense. Another stakeholder in this is the Joint Committee on Student Success. This is a 14-person member, bipartisan legislative committee focused on this very issue, and then a subcommittee of that group is really focused on the revenue associated with this education plan. I actually just read once, not more yet, because it just came out last night, their framework for the revenue options. And there's about 8 different options, all kind of, in the same gross receipts, business activity tax arena with just different tweaks. There's a ton of lobbyists involved in this. The LRO, the Legislative Revenue Office, is running all sorts of different models they're running models for the OBI, and then the CCG is having its models run by the elite economist that just retired, Paul Warner. So they're all comparing models, ultimately trying to flush out what's the best one, what polls the best, what's the most likely one that doesn't get referred to voters and ultimately rejected, like Measure 97. All right, so I'll go into some of the actual proposals themselves. Oops, I think I went too many. All right, so the first model is the CAT. This isn't something that's new to Oregon. We actually tried this last year in the 17 session. Haas was the sponsor of this bill. This effectively is a low-rate gross receipts tax, is imposed on all businesses. It's different than Measure 97 that everyone got familiar with, which was that 2.5% tax, on just C corps, picking winners and losers. This wouldn't operate that way. It would be a low-rate gross receipts tax imposed on everyone with some small business exceptions. The big drawback to this, or that most people don't like, is for someone that's, us at the retail context, if we're buying something from a retailer, that retailer's bought it from a wholesaler, and that wholesaler's bought it from a manufacturer. And now you potentially, rather than having, I'm just using this to illustrate it, maybe you had it's a 1% tax. Well, if there's 3 transactions, what is that tax really in the end of the game, or at the register? It's a tax at pyramids, and people don't like that as a result. But maybe it's not that big a deal if it's a low enough rate and everyone's paying it. Ultimately, it just results in inflation. So that is one of the more prominent proposals. It's likely going to be, at the table at the end. Is it going to be this one or is it this one? The other one that's getting serious airtime is the BAT, and there was some, really smart economists that really understand state tax policy and taxation, and they developed something specific for Oregon and looking at what types of businesses are in Oregon, and came up with a concept called BAT. It was largely modeled after a tax that was actually in operation in Michigan for 40 years, and there's a whole slew of reasons why it was ultimately sunset, mostly political ones, not that the tax wasn't working for Michigan. It was ultimately phased out. New Hampshire currently runs something very similar to a BAT today, which is largely being successful. Texas sort of has one, but it's slightly different, and it's largely been successful. And I'll go into what a BAT is. But if one of those two don't pass, the alternative, which I hope doesn't happen, is you just raise the tax through the existing revenue through existing tax, which means higher personal income tax rates, higher corporate income tax rates, and really makes Oregon less competitive because we've lost a lot of our economic development tools. And so I'm hopeful that we make our tax system a little bit more efficient and don't just rely on the existing ones and increasing them. You could also see some reduction of existing credits for the ones that we do have left. But there's a lot of people that say it won't raise enough money anyway, so I'm hopeful that's not the path that's taken. All right, so what's a BAT? So a BAT is actually, I'll try and do a simple explanation as possible. It's total revenue, less purchases from all your customers or your vendors. That's the BAT base. So if you're building a new manufacturing facility, any of those payments to the contractors, that's a deduction. If you're a wholesaler, any payment for inventory, that's a deduction. So it's total revenue less purchases from other firms. That's your base. And then your base is then multiplied by your total revenue in Oregon, based on current existing law, Oregon apportionment formula, over total sales. That's your apportionment factor. And then you multiply that result by your rate. And that effectively gets you to your new BAT liability. What ends up happening is because the BAT effectively just leads to taxing the value that's been added in Oregon. So it ultimately is your margin and your payroll and some other things. And it would extend to all forms of business, partnerships, sole proprietorships, anyone that's in business over $500,000. There's a lot more detail there on the BAT calculation itself. There's actually a BAT calculation tool that is being developed as we speak that's going to be rolled out to the business community so they can beat it up and make sure that they're coming up with the right design behind the BAT if it were implemented. A couple of things I do want to mention about the design elements of a new tax, whether it's a gross receipts tax, a BAT tax, or something a little different. And I've been in a lot of these discussions, and a lot of them fall on what's the best policy decision as to who should be or who shouldn't be. What's the right rate? Well, how do I factor in low margin businesses or high margin businesses? And should I have a multi-rate system to address that, or are there certain industries that we need to incentivize or give a break because we want to encourage their growth and because it's a sector that we want to target? It's really complicated, but these are just a number of the things that we're talking about in the design. Who should be subject? We want to tax out-of-state companies, so we want the lowest threshold possible. A bright line nexus threshold. That's like when a state can tax out-of-state business. So as little as $100,000 or more, makes a company subject. That's good policy because that shifts tax liability to out-of-state companies, versus in-state companies. And so a lot of that stuff is going on right now. What members are part of the group? How does it coordinate with other tax? It makes me a little nervous right now that it's going to be another tax on top of our existing tax. So if you're a closely held flow-through entity, you're still going to pay income on your distributive share of income. If you're a C corporation, you'll pay your C corporation corporate income tax plus a BAT on another schedule to your return. I'm hopeful the tax relief is enough to make a difference, but it's likely going to be some sort of combined filing. And then from a relief standpoint, I'm trying hard to get the people that are at the table to give tax relief for the right things. Like right now, we lost our R&D credit. That's not good for Oregon. So if we're going to impose a new BAT, let's interweave a R&D credit. We have enterprise zones, but we don't really have any tax credits for people that make investments. So maybe if we're going to implement a BAT, some tax relief maybe should be in the form of companies making investments. So we're hoping to weave in good economic development policy to this, so buy down this tax, for the right reasons. All right, so what's going on, right now? So all the parties are meeting with the legislature and different committees, and they're discussing all the alternatives, and they're creating these models to ultimately determine what's the right one or right two to really vet. I'd expect you're going to start getting those phone calls during the election time on public polling. I love getting those phone calls, especially when there's tax things, because I get to debate the people, and I think they find it annoying. I was just at a meeting a week and a half ago. Senator Haas was there. He actually kind of explained what all this stuff as it relates to education, why we need it, why we need these investments. It was kind of tearful hearing some of the things and stories, about why. But I just want to make sure it's done, right. And he was really open to design feedback, and I really appreciated that. We discussed the BAT in detail. We discussed the gross receipts tax in detail, the pros and cons of each. So I'm optimistic that the business community hopefully will engage, with all these different stakeholders and come up with the right one. Because if it doesn't, we're going to essentially be back where we were with Measure 97. We're going to have a very divided business community, and we'll be fighting, whether to, enact a tax or not, and it'll be a super expensive ballot campaign and a lot of annoying commercials. So I'm hopeful we all work together on that. So what's happened so far? We do have a couple of bills that are on paper. This is super early. It started the 22nd. What are we at, the 31st? So in terms of when we'll actually see an education bill, or the bill that will fund the education investments, I'm guessing the end of April we'll know, maybe first part of May, of the direction we're headed there. But as it relates to the stuff that's happened so far, we have a new tax haven bill, which we had it for a long time. It was sunset last year. and now they're bringing it back. I don't understand why. I find it curious. So basically, it includes income from foreign operations that's not part of your U.S. income if it's earned in a country that's deemed a tax haven. So Ireland, or there's a lot of different jurisdictions. They define them, in the law. The Finnegan Bill 207, this likely passes. This largely affects out-of-state companies, but essentially what it will do is it will pull in revenue earned by entities that don't have to file in Oregon. It will require them to start including their sales, in the group that already does file. Basically, it will increase revenue for companies that are primarily doing business outside of Oregon, selling into Oregon, so it makes a lot of sense. Oregon's had economic nexus for a long time. Dan's going to talk about Wayfair in a minute, but that's what economic nexus is. It's essentially, once you have enough revenue in a state can, bright line, use that revenue threshold as a means to say you're now subject to tax. Oregon's essentially going to adopt this concept and defines it at $100 million. So once you have $100 million, $100,000 in sales to Oregon, you have economic nexus. There may be other reasons why you don't pay tax, but they're essentially trying to do that, jumping on the bandwagon, post the Supreme Court case. House Bill 2160 essentially does the same thing, but makes it specific to minimum tax, which everyone probably remembers we implemented a minimum tax many years ago that ultimately caps out at $100,000, which I think is the highest minimum tax in the country. So that's interesting to watch. Another one, 2163, is a backdoor gross receipts tax. It essentially amends the existing minimum tax law, and for really large companies that have more than $100 million in revenue to the state of Oregon, they remove that $100,000 cap and now subject every incremental dollar to that 0.1% gross receipts tax. It's a creative way to do it, and I think if I were to do it, I would probably go down there because we already have existing law that just requires a little modification. On the last one, Oregon is a water's edge state, so we only include income, just around the boundaries of the United States. This proposal would shift to a worldwide, similar to California, and it would include all revenue and income earned all through the world, and then calculate apportionment and tax that would result. The interesting thing about these bills is they also would include some sort of corporate disclosure about what their income is in other jurisdictions throughout the world. So I find that curious, and it's interesting to watch. So I'm going to transition over to Dan so he can hit on some of the legislative issues that occurred here recently that you all need to be thinking about, as well as touch on the U.S. Supreme Court case in Wayfair.
Okay, thanks, Rob. So Rob really was discussing kind of the future and trying to maybe forecast the future. I'm going to walk through changes that have already happened, so things that have already been implemented recently. And I'll start with Oregon business income tax. So one of the most significant tax changes in Oregon for the 2018 tax year is the change to market-based sourcing. And what this is it's an income tax concept dealing with the apportionment or allocation of income for service and intangible revenue. So historically, if you're a company doing business both inside and outside of Oregon, you would apportion service and other intangible income to Oregon if the majority of the costs of performing those services were incurred within Oregon. So for an Oregon-based company that's actually headquartered here in Oregon, service and intangible income was generally all apportioned or sourced to Oregon for income tax purposes. Now, effective for tax years beginning in 2018, service and other intangible income will be apportioned to Oregon to the extent the service is delivered to a location in Oregon, or for intangibles basically to the extent that the intangible is used in Oregon. So this could be a pretty big change for companies that have large amounts of service income or intangible revenue streams. The key takeaway here is that to the extent that your business files for income tax in states outside of Oregon, you need to review your apportionment, especially if you have large amounts of intangible or service income. Review your apportionment to see if there's any changes that are needed. For Oregon-based companies, this actually could provide an opportunity to source income that's historically been all apportioned to Oregon to other states if your customer base is outside of Oregon. So this is actually a fairly significant change in the business income tax world. There are also now apportionment rules for the sale of software and digital goods. So if you're selling software and if it's pre-written and delivered via tangible media, it'll be treated as tangible property and sourced to basically the or where your customer is located. And now for other types of software that aren't delivered via tangible medium, like software as a service or other digital goods, you'll basically look to these new market-based sourcing rules, which is a change from previous law in Oregon. Okay, so switching now to individual income tax. So beginning back in 2015, Oregon law allowed certain taxpayers to elect to compute tax on qualifying income passing through from a pass-through entity, a partnership, or an S-corp using reduced tax rates. So this is something that's really been in effect since 2015. The brackets apply a lower marginal tax rates to income up to $5 million. There are certain qualifications that have to be met in order to make the election. The income must be non-passive. The taxpayer must materially participate in the business generating the income. And then there's some employment requirements. So during the 2018 special session, House Bill 4301 was passed that extended this benefit now to sole proprietorships also. So sole proprietorships that meet these requirements are now subject to these lower tax rates in Oregon. So something to be aware of. There's been attempts to limit the applicability of these reduced tax rates, trying to limit the amount of income that these rates apply to, things like that. So far, all these efforts have died, but we'll be looking for more proposals in the next session, in the 2019 session, to see if there's any other limitations that are placed on these lower tax rates. Okay, there we go. So that really covers Oregon and income tax. Moving on to sales tax nexus in the Wayfair case. So unfortunately, Wayfair and the Wayfair decision is not good news for most taxpayers, especially Oregon companies that haven't historically had to collect sales tax outside of Oregon. The traditional or historical rule for sales tax nexus, based on Supreme Court precedent, was that a state couldn't require an out-of-state retailer to collect tax from customers unless the retailer had physical presence in that state. In South Dakota versus Wayfair, the Supreme Court decided that physical presence is no longer needed for sales tax nexus. So what happened in this case was that South Dakota implemented a new law that required remote retailers or remote sellers to collect and remit sales tax to South Dakota if the seller had over $100,000 in annual sales to South Dakota customers or over 200 transactions. So Wayfair, the Wayfair company, which did not have physical presence in South Dakota, said, wait a minute, this violates the Quill decision that the Supreme Court had come out with years earlier, and said that this isn't right. We're going to challenge this based on the historic Supreme Court precedent that a state can't require a seller to collect sales tax unless they have physical presence in that state. The Supreme Court ultimately found in favor of South Dakota, holding that the physical presence standard no longer applies. The relevant factors that the Supreme Court pointed to were that the South Dakota law has a safe harbor provision. So there was a limitation of $100,000 in sales, annual sales, or 200 transactions. So this wouldn't, impact the smallest of sellers or people who are just selling, small amounts of goods on eBay or something like that. It wouldn't impact them. It was only going to impact, moderate-sized companies. The law is prospective only, so it's not retroactive. And South Dakota was a streamlined sales tax member. I don't really think that fact is too significant, but the Supreme Court did point it out. Basically, all that does is it simplifies the registration and filing process for sales tax. So, of course, no surprise, after this decision came down in June of last year, tons of states followed suit and followed what South Dakota did and adopted South Dakota-style Wayfair laws. And so here I have a slide with the solutions by state as of today. So there are over 35 states that have implemented economic nexus or Wayfair-style laws. Many of them have adopted the same standards as South Dakota, so the $100,000 in annual sales or 200 or more transactions. One state I want to point out is Washington. They're listed here as having economic nexus effective 10/1/2018, and that is the effective date for sales tax economic nexus. But for B&O tax, which is business and occupation tax in Washington, which is their gross receipts tax, Washington has actually had economic nexus standards for a number of years. Back in 2010, they implemented economic nexus for service receipts, then for wholesaling receipts in 2015, and then for retailing receipts in 2017, with the threshold being $267,000 in annual sales. So if you have customers in Washington and you are selling into Washington, now you may have sales tax nexus, you may have historically had B&O tax nexus. Just by having sales to customers located in Washington. Let's see. So what's next? Well, first of all, this impacts a lot of people. Don't panic. The most important thing to do is if you haven't done some kind of nexus or taxability study or evaluation, that would be the first step to figure out if you possibly have some kind of tax exposure for sales tax. The next step would be if you determine that, yes, I do have sales tax, nexus now under these new economic nexus standards, consider registration and compliance and how you're going to do that. This has really actually impacted Oregon taxpayers particularly because a lot of Oregon companies are not registered for sales tax. So a lot of Oregon companies we found don't even have, any kind of software solution to be able to collect sales tax. So this isn't something that you can just, start doing tomorrow if you haven't been doing it. It takes a while to get these processes in place, which is the next point. Will states be kind? There is a general understanding, I think, among states that they will give vendors or sellers time to kind of figure this out. Texas, for example, is giving a 4-month grace period. So once you hit the sales threshold in Texas, you have 4 months then to begin collection. So there is a 4-month grace period. So the key takeaways are, 1, physical presence is no longer the rule for sales tax collection and filing. Economic presence will be relied on moving forward. States that haven't adopted laws are working on doing that right now, so this is a very big deal. There'll be uncertainty over the next 6 months or longer as states continue to respond differently to the Wayfair ruling. Federal legislation, there's really no talk of that at this point. The federal government's basically giving the states autonomy to figure this out and implement their own rules. So just stay informed, be methodical in your approach, and seek advice as needed to navigate these changes and to figure out, if this is something that you should be concerned about. I have a few minutes left, so I'll just quickly talk about enterprise zones, Oregon enterprise zones. which is some good news. That's Wayfair being mostly bad news. So the E-Zone program in Oregon offers property tax exemptions for certain businesses that locate or expand their operations within a designated enterprise zone. It's something to think about if you have expansion plans or you'll be making other large capital expenditures in the future. There we go. So there are qualifications that you must meet in order to take advantage of the Enterprise Zone program. There are 69 E-zones in in Oregon. Here's an example of the Medford Enterprise Zone and the boundaries. Skipped over some stuff, but so generally a qualified business must be engaged in the business of providing goods, products, or services to business through its activities. So manufacturing, processing, shipping, those are all qualifying industries. Non-qualifying would be retail or other financial or professional services. Qualified property includes newly constructed buildings or structures, additions or modifications to existing building structures, heavy affixed machinery and equipment, and personal property valued over $50,000 per item. There is a hiring requirement. A business must increase full-time permanent employment by the greater of one employee or 10% of the company's annual average employment. Basically, this slide is just that program or E-Zone sponsors can impose and collect a filing fee. An application, this is important, application for authorization must be submitted before hiring or site work begins. So if this is something, if you're considering expansion in the near future or capital investments, this is something to start talking about right away. And then we just have a couple slides for long-term rural enterprise zone facilities. Basically, if you're in a long-term rural enterprise zone, there are even greater benefits available, but there's also some additional qualifications. So I think that covers it. I think we're right on time, but we do have time for questions.
Roy Lindsay, Mayor Grants Pass. I was up in Salem last week, and one of the things that I heard was tax, tax, tax. But there has been little or zero talk about the spending problem. And so many people are saying, our state government is spending too much money. We don't know where it's really going. What can be done about it?
Yeah, I don't know. Rob, do you have any have you heard anything about that? I'm going to pass this off to you. Rob's been much more involved in the recent discussions around tax reform.
Honestly, I wish I had an answer to that, and I completely agree with you. None of us could, balance our budget, our personal budget that way, by continuing to, just spend and spend and spend and not look about what programs are critically necessary, whether they're being efficient. But I'm not an elected member of the legislature, and I don't get to make those policy decisions. That's why I encourage the business community to really talk to those stakeholders and require, a one-for-one. Every new dollar requires, $1 saved. Things like that, I think, if business was unified, can make a difference. But I don't have a perfect solution to that. Yeah. It's discussed a lot by the organizations that are kind of speaking to the legislature and the governor's office, whether it's kind of falling on deaf ears or whether we're getting remarks to kind of appease the question, and they're going to do what they're going to do. It's hard to say. I having just said that, I was somewhat optimistic. I'm kind of an overly optimistic person. On my last call, they did seriously talk about PERS reform. Whether it actually happens is impossible for me to predict. So it is being talked about.
Rob or Dan, could you address where companies could or businesses could get a list of the states that have followed the Wayfair thing? Do you have a reference on that for us?
Yeah, so well, there is a slide in here on those states, and there are a lot of actual resources out there that have a list of those states. One of them is the state, is it Sales Tax Institute? Sales Tax Institute, they have a website with a list of all the states that have adopted Wayfair legislation. So that's a good one to go to. And then there's other firms and other websites where these things have been posted. I like the Sales Tax Institute website is actually really good. If you go there, you just Google it and find the Wayfair page. You can actually click through and see the state's specific law, and you can see specific notices or things like that the states have issued. So if you're looking for more information on a specific state, I would recommend going there.
Or just email Dan, and he'll give you the list.
Yeah, yeah. That's right. Yeah, there's a lot of local taxes, city and county sales taxes, and so a lot of those local jurisdictions follow the state law. So if you have Nexus now for state purposes, you likely in a lot of these states also have Nexus for local sales taxes, and that's where compliance becomes really important, and finding some kind of software solution that can help you, because it's really hard to do it manually.
One more question, Riley.
Can I respond a little bit to the cost containment question? My name is Alex Campbell. I'm in the governor's office, and I just wanted to let you know that one of the primary areas that the governor is looking at for cost containment is the Secretary of State did a recent audit, and we believe there's a lot of opportunity for cost containment and savings in reforming state procurement policy. The other thing that I'd ask you all to just keep in mind when you think about the big numbers in the state budget, vast majority of the state budget is healthcare and education. Healthcare expenditures are largely governed by federal rules, and education expenditures are largely decisions made locally. PERS is a big factor, obviously, in that local education costs, and we certainly are interested in trying to figure out solutions on that point. Thanks.
There's talk about Congress stepping in and doing something about this, to where there's a federal guidance or kind of a federal standard for how states how they do this, and how, the standards they have, and I think that states are, or the federal government is so. In all areas of tax, income tax, payroll tax, giving autonomy to the states and letting states, kind of run their own economy or run their own government. So I have not heard, I don't know, Rob, if you've heard anything recently about any kind of federal legislation. There was a lot of talk about that before the Wayfair decision came down. I think the Congress thinks that the Wayfair decision kind of fixed it. But yeah, it's complicated, and I don't see it getting any better. So, yeah.